Hi, I'm Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nathaniel Eckman and Alan House. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York-based headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's Investment Research Department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800 Value Line. Now let's discuss the economy and the stock market. This content was prepared by the Value Line economic staff. The Federal Reserve held the benchmark short-term interest rate steady in the range of 3.5 to 3.75 at this month's policy meeting. The decision gives the Federal Open Market Committee more time to assess increasing risks on both sides of its dual statutory mandate to promote price stability and foster full employment. This pause also allows the Fed to monitor the impact of the ongoing war in the Middle East on the global energy markets and ultimately the U.S. economy. The gross domestic product slowed to an estimated advance of just 0.7% in the final quarter of 2025. Inflation is running above the central bank's comfort level. The Personal Consumption Expenditures and Price Index, the PCE, which is intended to measure changes in average prices of a wide range of everyday goods and services purchased by individuals, increased in January. Specifically, the PCE and core PCE, which excludes food and energy, rose 0.3% and 0.4% respectively on a month-to-month basis. From a one-year perspective, the PCE and core PCE increased 2.8 and 3.1% respectively. These increases in the inflation measure, trusted most by Federal Reserve officials, were still notably above the Fed's target rate of 2%. The readings also were taken ahead of the recent jump in global oil prices, which will likely put additional upward pressure on prices at both the producer and consumer levels. This makes the Fed's task of reining in inflation more difficult. U.S. Treasury note yields rose on this concern. Meanwhile, the labor market has shown signs of weakness. The Labor Department reported that the nation lost an estimated 91,000 jobs in February. The report also showed an uptick in the unemployment rate and a sharp drop in the labor force participation rate, which indicates some slack in the labor market. On the positive side, initially weekly unemployment claims remain quite contained, and the job openings and labor turnover survey showed that U.S. job openings rose to 6.946 million in January of 2026, rebounding from a five-year low in December. In conclusion, anxiety in the stock market has increased on the above concerns, leading to a multi-week losing streak for the major equity averages. Given this volatility, we recommend maintaining a portfolio consisting mostly of high-quality stocks and cash-equivalent securities. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to assure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line digital booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To increase the digital booklet, first head to the dashboard where I am already located and then click on the investment survey under Traditional Online Access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is open, navigation is as easy as flipping the page or alternately jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stocks and shareholders. This content is posted throughout the day on our website, again, valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserves over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock safety rank, an important tool to measure risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the Investment Education section of our website. Now let's move on to the one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call again 1-800-VALUE-LINE. Today we're going to be looking for reliable companies that balance strong year-ahead prospects with good total return potential over the long term. And we'll start by applying our time-tested safety ranks, and we're looking for a safety rank of 1. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 being the highest to 5, with 1 including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank of 1. And by applying that first criteria, we've trimmed our potential candidates down from 5,700 to, I believe, 93 candidates. Our second filter is a timeliness rank of 2 or better. We're going to filter for timeliness now. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the Value Line universe. The format is an easy-to-understand scale from 1 to 5, with those ranked 1 likely being the best performing issues on a relative basis. Most often, buyers will want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better, and applying that filter, we're now down to 21 candidates. The third filter we are going to choose is one of price stability, and we're looking for stocks with a price stability rank of at least 95. That is on a scale of 1 to 100. And applying that filter, we find ourselves down to 16 candidates. And the last filter that we are going to apply is earnings predictability. Again, that is on a scale of 1 to 100, and we're looking for an earnings predictability of at least 90. By applying this screen, we've chipped away the list of prospects down to our final 9 candidates. They are Amatec, Church & Dwight, Enterprise Products, CGI Incorporated, Illinois Toolwork, Johnson & Johnson, Lean Corporation, McKesson Corp, and Republic Services. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them all. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Enterprise Products, ticker symbol EPD. Before I click on Enterprise Products, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top. Now, let's go to the last full-page report. Clicking on the last full-page report on Enterprise Products. There we go. Enterprise Products is one of the largest midstream operators in North America, with both natural gas and petroleum pipeline operations and storage facilities. It is also a master limited partnership with certain unique tax considerations. As such, we advise that investors seek advice from a tax advisor on whether this investment is appropriate for their portfolio. We think that the significant dividend yield is a major attribute. It has been raised for 27 consecutive years. Plus, on a fundamental basis, prospects appear bright. After heightened capital outlays in recent years, we think EPD is well positioned to have greater profits fall to the bottom line. Our 3 to 5 year price target range on the stock is 50 to 65. Our stop loss, the price of which we would plan to sell in the event of a price decline, is $31 based on yesterday's closing price. In summary, Enterprise Products has decent earnings growth potential and a generous payout that should lead to attractive total returns on a risk-adjusted basis. It is today's one stock to buy right now. Before we go into our question and answer session, we would like to note that we have sold our past one stock to buy right now recommendation, as its fundamentals and or valuations have changed since we presented on the stock, that stock being Microsoft. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few were submitted prior to this presentation. Now I'll hand it off to Nathaniel and Alan. Thank you.
All right. First up, I've got a question here that's asking, what are the three figures at the bottom right of the value line page? And if we could scroll down to highlight those, please. Yeah. So those down there. For those, we have earnings predictability, stock price stability, and price growth persistence. Earnings predictability is a measure of, how reliable an earnings forecast from the company tends to be. It's based on, the stability of year-to-year comparisons, and we weight recent years more heavily than earlier ones, since, that sort of performance can change over time. So we weight the more recent data in making that model. Earnings stability, meanwhile, we derive that from the standard deviation of the percentage changes in quarterly earnings over an 8-year period. And so the most reliable forecasts for that tend to be the ones with the high rating 100. The lowest rating we give for that is a 5. And then price stability is a relative ranking of the standard deviation of weekly percentage changes in the price of a stock over the past 5 years. So it's, again, it's a, relative to the rest of the stocks we cover, it's ranking the standard deviation of, how much that price is moving week to week. And so the most stable get 100, and once again, the least stable there are getting a 5. And then finally, we have the price growth persistence. And that's a measure of, the tendency of the stock to, show persistent growth. And that's once again relative to the average and on a scale from 5 at the lowest to 100 at the highest. So looking at this, you can see it's a very stable stock in terms of price. The growth persistence is on the lower side, but it's very, very stable and predictable in terms of what it's going to do. So if you look at, our earnings projections there, because, obviously we're using our own judgment, but we are also, of course, looking at, the company's, guidance and projections. And so we can expect that it'll probably come in fairly close to our estimates there, because this doesn't tend to be a company that throws a lot of curveballs in terms of the earnings. It's very stable. And then where is our stop loss recommendation located? We don't put that on the individual pages. We don't print a stop loss on the pages, right? Because that's going to depend on what exactly the price was when you bought in. And we have a recent price on each page, but we don't know exactly when you're buying it. So the page has data, but we can't give you a stop loss on the page. We do, however, have, stuff like this webinar where we will tell you, we have model portfolios where we will tell you when we're selling. We have products that will tell you when we're selling, and that is something that we do that most other services like us do not do, but we don't have the stop loss directly on the page. I see another question. Have we ever, are we considering using artificial intelligence in our comments? And I'm just going to address this definitively. No, we absolutely are not. AI is very good at certain things, but, it's quantitative, right? What AI is fundamentally is it's a mathematical model that predicts what should statistically go next in, a sentence or whatever. And that makes it very well suited for certain things, in this line of work. but more on the numbers side. And, the whole reason we have a comment is, we give you all of these numbers, we give you all of this quantitative data, but we also want to give you some qualitative analysis of, the company and what we think those numbers mean. And that is not something that we think that AI is well suited to. And, you see a lot of other providers in this industry going, whole hog on these sort of AI generated analyses. And we think that's very backwards. We think that you're sort of in some ways sabotaging yourself if you're presenting what can really only be a quantitative assessment coming out of this mathematical model as if it's, this qualitative analysis. We think that's very wrong-headed, and so we're not going to do that. We're always going to keep, the comments human written so we can capture that sort of qualitative expertise that our analysts have for you. Do we start the stock screener with the large cap stocks? It depends on what you're looking for, right? You can screen for whatever you like in the screener. There's a specific screen, for market cap, and you can put whatever bounds in there you like. You can use the cutoffs that we use for the various market caps. You can set your own. You can do whatever you like with that. I'm not seeing anything else that I think we can address here in terms of the questions. I don't know. Do you have anything, Alan or
Yeah,
Charlie, that you'd like to jump in on?
Nate, we just had a question come in about someone wanted us to go over the screens that we use today for the screener. I just want to go over that very quickly for those that might
Yeah.
have jumped on later, might have missed a screen.
Oh yeah, good catch. Good catch.
So we had a safety rank of 1, a timeliness rank of 2 or better, price stability of at least 95 out of 100, and earnings predictability of at least 90 out of 100. So those were the parameters we used to come up with the 9 stocks that were in our final screening.
Yeah, and I'm actually seeing a follow-up to that. Someone's asking, where do they find this one page? So if we could go back maybe through the steps of how we got to this page from the screener, just to demonstrate.
Sure.
Yeah, and so from the screener, I don't know if we need to go all the way back there, but when you do the screen, you'll get a list of companies. If you click on those, you'll come to a page like this, and then from here, oh yeah, we can just jump into the screener and just do, just punch in anything, and then that'll give us some companies. Yeah, and then you see you get the list of company names there, and you can click through. And if you click through, then if you go onto the side there, you'll see that little, there's a PDF reports button up there. You can, it's sort of hidden behind the securities banner pop up there. But you can go through that to get to the one pager. And if you scroll down to the bottom, there's another link that can also get you there from that page. And then you'll get to here. And we've also got those in the digital booklet we showed you earlier. And if you're subscribed to the print products, you'll get those in print.
Okay, well, thank you, Nate. I think that's all the questions we had today. We thank you all for joining us.